Welcome to 360 Money Matters, where financial planners Billy and Andrew talk all things financial planning. This podcast aims to increase your knowledge and confidence with all things money. Each week, they will cover topics like wealth creation strategies, investment principles, creating passive income, paying off your debt faster, and much, much more, so you can live a life on your terms without limits.
Hello and welcome back to another episode of the 360 Money Matters podcast. I'm Billy and I'm joined by my co-host,
Andrew. Back again, Bill's got another podcast for us today.
Andrew, we do have another podcast and today is going to be a really juicy one and really timing and fitting as well too. We're recording this on Wednesday, the 4th of May. So it's the day after the interest rate announcement from the RBA yesterday.
And if this is news to you, you must have been living under a rock.
So this will be coming out a week and a day after, or being published a week and a day after this has happened. But today we're talking all about interest rates because it's been obviously all over the media, and from our own personal experience as well too, we're starting to field some calls in our particular business around clients asking what's going on with interest rate increases and how it's going to have an impact on them.
Yeah, absolutely. So today's topic of conversation is all about interest rates and the RBA movement and what impact that's going to have on, one that everyone expects is if you're making mortgage repayments, that obviously your repayments are going to increase and, the impact that it has to that. But, more broadly speaking, what impact is it going to have to the market? What impact is it going to have to, financial markets and the broader economy as well? So all about interest rates today, Billy.
It's an exciting one, mate. And I must say, it hasn't been a topic. Rising interest rates. It's been on the cards. We knew that this was going to happen. So it's nothing that's caught us out of the blue and it's too surprising. But the last time that the Reserve Bank of Australia increased interest rates was in November of 2010.
Yeah.
So it's been a really long time
Almost
between
12
drinks.
years.
Yeah, really significant amount of time. And it's abnormal. It's not how the RBA and the official cash rate is usually controlled. So it's been something new for a lot of people because they haven't experienced this before.
Yeah, well, I can say from my own personal experience, this is the first time since having a mortgage that interest rates are on the rise as opposed to on the downturn. Maybe for you, you would have seen the Great Recession, the Great Depression, all of that stuff and seen a few interest rate rises in your time, but first one for me.
I was going to leave that quiet and just let that one sort of slip by and not talk about my age So yes, I have been through interest rate rises before. But this is going to be something new for a lot of people. I guess there's a little bit of nervousness out there in terms of what we've heard. So hopefully today goes a bit of a way to sort of our thinking around what this looks like as financial planners. And hopefully it gives some people some comfort around what this is going to look like. Because yes, we're in an interesting time in the world with, supply chain issues. There's a war happening in Europe. We've obviously still got COVID hanging around, but
lockdowns in China.
Interest rates increasing, decreasing and moving are all part of the natural cycle of how governments try to help control, stimulate or slow down an economy depending on what they're doing. So hopefully it gives some people some comfort around what's going on at the moment. But yeah, let's get straight back into it. Andrew, what are we looking at as at yesterday?
Yeah, so as at yesterday, RBA increased interest rates by 25 bips or 25 basis points. So official cash rate is now at 0.35%. Which, when you sort of look at it on a percentage basis, it's a massive increase from, we're talking a 0.1% to 0.35%. But when you're talking about a cash rate of 0.35%, it's still a historically incredibly low interest rate environment. So I think that's something really to note that, yes, we have seen a rise in interest rates. Yes, it's, a different and a new experience. But when we're looking at the global context, when we're looking at a historical context, it's something that's still at very historically low levels. The RBA obviously felt that now was the right time to implement that rise in interest rates. It's something that's sort of been talked about, has been on the cards for, the better half of a few months. I think one of the major determining factors was the inflation numbers that came out. So rising inflation, coupled with the fact that there's been a decrease in unemployment, but really the rise in inflation and combating that was one of the main drivers behind the RBA increasing rates yesterday.
Yeah. And, just throwing back, you're talking about the official cash rate being at all-time lows. It's very, very easy for a government to be able to, or a central bank, to be able to decrease the rates if you've got the deduction to give. Whereas when you're at all-time historic lows, which is what we've seen across the world for a long period of time, there's nowhere really to go. So from the Reserve Bank's perspective, and this is no different in Australia than what we see overseas, This is going to sound a bit counterintuitive, but the sooner they can get interest rates, the cash rate normalized again, then they can start using that tool in their arsenal like it's designed to be used to dial it up and dial it down to try and stimulate or slow down the economy, depending. And the reason why I've kind of said that is because last night I was reading the minutes from the RBA announcement, and it's pretty clear and pretty evident that this is the first of many. So this is not going to stop anytime soon. They don't really give any indication about where it's going to go, and obviously they've got to wait and see the impact that this is going to have on the broader economy, and they're looking at a whole heap of different metrics and stuff. But where we're at now, 0.35% with a 0.25% increase yesterday is the start of it. And we're going to see that continuing to happen. What I found interesting as well too, the Reserve Bank usually doesn't like doing this stuff at the same time as when there's an election on, because they don't want to be seen to be, I guess, not necessarily influencing voters, but you thinking that an interest rate rises because of a particular government or whatever it may be. But we're at a point in time where we've got the federal election coming up this month, and the Reserve Bank felt like they couldn't wait any longer and they needed to pull the trigger and move on this pretty quickly.
Yeah, and I think that's an important note. I mean, a lot of the stuff we'll run through and sort of talk about over the course of this episode is an increase in interest rates, more broadly speaking, will have a negative impact to markets across, multiple markets. And so you think about, what's been going on, where the market's at, some of the recent volatility, and you're like, why are they increasing interest rates? Even though it may have an impact as at today, what it's going to do is it allows you to breathe a sigh of relief, and it allows the RBA to have that in their arsenal if something does happen at a future point in time and they need to stimulate the economy and drop interest rates at a future point in time. When you're at 0.1%, you've played your hand. There's no more levers left to pull. I mean, outside of when you're talking about monetary policy, there's no more levers left to pull. And so ultimately, this is a return to normalization so that they have the ability to control and influence the economy at a future point in time. So tell us, Bills, I mean, increase in interest rates, we've touched on it, but what's sort of one of the impacts that that's going to have to the broader market, the broader economy? What are we likely to see as a result of this?
I mean, in a really simplistic sense, when a Reserve Bank, echoing your comments before, but when a Reserve Bank increases rates, it's designed to slow down the economy. And we won't talk about how much it's designed to slow down. And the opposite of that's true as well too. So if you're in a particular country and the Reserve Bank wants to stimulate the economy, they'll reduce the official cash rate. Simply from that perspective, the official cash rate determines and influences how households and businesses can borrow money, how expensive or how cheap that is. So if you're we'll call it a business, and it's actually been the same for households in Australia as well. But if money is cheaper to service, being the interest rate is less, you're more inclined to spend more money and deploy that in productive assets in the economy. So if you follow that sort of logic through, that will stimulate the economy, leading to more businesses being created, being more investment in businesses, meaning more profit for businesses. So it's designed to stimulate and grow the economy. In this instance where we've seen the Reserve Bank increase that, we should be expecting the opposite, where it's going to start to slow things down. Now, depending on what this looks like with a whole range of other factors, supply chain issues, the impact of that's having on inflation, what's happening from an unemployment perspective, we should start to see those things start to taper down a little bit, and the Reserve Bank are going to be keeping their finger on the interest rate lever and keeping an eye on what's happening to be able to turn that down as and when they see fit, because they want to try and slow things down. And realistically, from this perspective, you hit the nail on the head before, Andrew, with inflation. So we've got to do some things to get inflation under control. And the second thing is unemployment in Australia is at an almost 50-year low, which on one hand is great, but on the other hand, it creates a whole range of other issues as well too. So to sum all of that up nicely, we're going to see things slow down. Pretty simple.
And that's across, one of the other things to consider as well is this isn't an unexpected decision. So this is something that we've expected. This is something that the market has already anticipated. And so it's not quite as simple as RBA increases interest rates, market drops the next day. It's as and when the market anticipates that this is going to happen, the market moves with that anticipation that it will happen. And so as a result, what we're experiencing is the market, to some degree, has already factored this in. It's already been factored into asset prices. It's already been factored into share prices. And to some degree, it's probably also been factored into property prices also. So it's not like, you expect that a rise in interest rates and that's going to happen, after it happens. It's in anticipation for that to happen. So it's not like we're saying market's going to go down, pull your money out, sell out of everything, because, you've got between now and, when the RBA makes the next decision to do it. It's the expectation of it is physically going to slow down the market as well.
Yeah, this does not come as a surprise. I mean, you find that if you're looking for it or listening for it, you'll see this rhetoric in the media in the last couple of months, and it was getting louder and louder leading up to yesterday's decision. So it should not come as a surprise right across the board. I don't think so.
And I mean, I guess the other thing that obviously that will also have an impact on is property prices as well. So what you're going to see and what you're going to experience is, more of a hesitation around borrowers, more of a hesitation around people that are, borrowing money, which is the vast majority of people in order to get into the property market or get into a property. And so what you'd naturally expect is at least a slowdown in the property market or in the momentum that's been in the property market. Again, you have to take this in context. So you can't say, okay, I entered, or, the peak of my property, it was worth X, and then interest rate decision happens, property market declines, and all of a sudden I've lost money. You also need to take into account how long you've held that asset for, and the fact that the property market has done exorbitant rates of return in the previous 12 months. And so as a result, yes, there might be a slowdown in the short term, or yes, there might be a slowdown throughout this period of time, but you need to take that into context with your broader portfolio and when you've actually, entered the market.
Yeah, probably a key thing that I want to pick up on there is the amount of growth that we've experienced has been abnormal. Interest rate increases will slow the growth rate down. There's been commentary, and no matter where you look, there's always doomsdays about property prices going off the boil and things like that. We're going to put some numbers around, I guess, yesterday's announcement and what that means from an absolute perspective based on some hypothetical loan amounts and some hypothetical interest rates. And look, you've got to put this into some sort of context, because you look at the media and the media jump up and down all about it, and it sells, right? It sells newspapers and gets eyeballs and things. But when you actually do the calculations and put pen to paper, and I don't want to sound like it's not a big deal, but in the grand scheme of a 30-year term mortgage, you're buying a very expensive asset. The numbers shouldn't be a small increase like 25 basis points like we saw yesterday should almost be insignificant, that it has no impact whatsoever. And that will make a little bit more sense when we get into the numbers down the track. But the other thing that I wanted to highlight is when the banks assess a client for the repayments, say your repayment is your interest rate is 2.5%. The banks actually assess the client on an assessment rate of at least 200 basis points above and beyond their prevailing interest rate. So the banks have already factored in that borrower who's borrowing at 2.5% can afford it if interest rates went up to 4.5%. So a 200 basis point increase. So they've got all of these measures in place where they've stress tested the borrowers that they were, before they gave them the money to borrow, they were considering how, risky that borrower was. And in the event that interest rates increased, can they afford to borrow it? So hypothetically, there should be no issues with people paying their mortgage back, assuming that prudent lending standards were adhered to.
I was about to jump in there, but yep.
That's probably another podcast altogether. But, there should almost be nothing to see here, for a little while yet, because on paper, from the way that the banks have assessed lenders or borrowers, they should be in a position to still be, and I'm not saying it's not going to be uncomfortable, but they still should be in a position to afford significantly more interest rate rises before we start to see any issues or shocks with the economy.
And that rhetoric, it rings true as well. If you've got a prudent financial plan, this should all be factored in. I mean, if you've already got a cash flow strategy and you're not factoring in the fact that interest rates may not increase in the future, you're doing something wrong. You should definitely be factoring in the fact that expenses may increase, interest rates may increase, and having some buffers within your strategy to be able to account for events like this, and for you not to need to drastically affect your lifestyle or change your lifestyle in order to be able to afford rising costs of living with inflation, increase in repayments as a result of increased interest rates. So all of this shouldn't come as a dramatic shock. And, what we'll sort of run through, I guess, now is what the actual impact is on some assumed loan amounts and what the impact to your cash flow should be based on, a variety of assumptions, but based on average loan sizes and whatnot.
Yep. No, I think that's probably a good segue into it, Andrew. So we're going to throw some numbers around now. So hopefully we do it justice and we don't get lost in these calculations. But
get a pen and paper handy.
It'd be much easier if we were doing this over video and we had the whiteboard, Andrew. That'd be perfect.
You've said that a few times in the podcast. I think it's a sign that maybe we need to move to a visual platform, but maybe our faces just are only made for radio. What do they say?
Well, I don't know if that will help the level of engagement go up or the level of engagement go down, but let's not risk it, right? Just in case. So let's just assume we've got a borrower that's borrowed $500,000. Obviously, the loan term, we've assumed a 30-year rate.
Yep.
2.5% interest rate on a principal and interest loan. What are we looking at? $1,976 principal and interest repayments per month. Yesterday's announcement comes along. We have a 25 basis point increase. That then increases the number to $2,041 per month.
In terms of repayments.
In terms of your repayments,
Yep.
which is from before the rate rise, it represents a $65 increase per month in repayments.
Yep.
That's over 25 basis points. And if we have another, so next month, first Tuesday of next month, the Reserve Bank will meet again. If they do another 25 basis point increase on the same hypothetical scenario, the principal and interest repayments per month will go to $2,108, which is a $67 increase per month from
The previous month.
Yeah.
So total increase in repayments of $132 per month before any increase after two 25 basis point increases.
Yeah. Yep. Exactly right. So, and I'm not saying $132 a month is not going to hurt people, but if you're making repayments of $2,000-ish per month, there should be enough in your financial plan, in your arsenal, in your savings, in your surplus, where you can absorb $132 additional.
I'm just going to come right out
Call a
and say
spade
it
a
and call a
spade.
spade a spade and the shovel a shovel. If you can't afford a 0.5% basis point increase and an extra $132 a month in repayments based on a $500,000 loan, if that's how fine your budget is, you should not have a $500,000 mortgage.
I completely agree. Completely agree, which goes against what we're seeing in the media.
Yeah. I mean, look, the media is always
yeah.
going to sensationalize. They're always going to say that, when times are good, the market is rising like we've never seen it rise before. When times are bad or where there's, any slip up, everyone's going to go broke and no one's going to be able to afford their mortgage repayments. So they're always going to be reporting on the extremes. But when you sort of break it down into numbers, not to downplay the fact that, yes, it is going to have an impact on borrowers, it is going to have an impact on people's cash flow, but there should be sufficient buffers in place in order to be able to account for that.
Yeah. Yep.
And it does show one side of the equation. Now, this is impossible to calculate. So I am going completely off on a tangent here and probably shouldn't be when we're sort of a third of the way through our numbers. But if the interest rate decision is having the impact that you'd expect on the broader market, then what's happening is, yes, your mortgage repayments are increasing. So consumer spending is slowing down. As a result of a slowdown in consumer spending, you'd expect inflation to decrease. And so as a result, yes, your mortgage payments will increase by, an extra $65 a month based on a 25 basis point increase, but your cost of living should also decrease. Now, how much that decreases and trying to work that out is, an impossible calculation, as well as the fact that the timing difference between those two is not the same. But there is another flip side to the equation that also comes, into factor as well.
No, well said. And on those numbers, just going back to it, I mean, yes, you're right. That shouldn't have too much of an impact. But where we are starting to hear a bit of noise is we're not just dealing with the rising cost of living through inflation. We're also having the impact on interest rates as well too. So household budgets are obviously going to take a hit. Consumer spending, because households don't have that surplus or that discretionary income, they might tighten their belts a little bit because, we need to put more money towards keeping a roof over our head and going to the grocery store. You should start to see those things play out, which is exactly what the Reserve Bank are doing. And this is the reason why they're doing it. That should have flow-on effects through the economy and start to really push back against inflation. That's what we're kind of hoping. is going to happen as a Reserve Bank decision.
Yeah, exactly. And so, yeah, tell us, Bills, that's on a $500,000 mortgage. What if your mortgage is $1 million as opposed to a $500,000 mortgage? What are the numbers? What do they look like? And what's the impact in terms of the mortgage repayments on $1 million?
Yep. So same scenario, 2.5% interest rate, principal and interest, 30-year term, $1 million debt. The principal and interest repayments per month is $3,951 per month. Yesterday's decision gets handed down. That the interest rate then goes to 2.75, so a 25 basis point increase. The repayments now move to $4,082. So from yesterday to today, we're seeing a $131 increase in repayments per month. And then once again, if the Reserve Bank decide to do the same thing again next month, the repayments on that same hypothetical loan go to $4,216 per month, representing an additional $134 per month repayments based on the previous month. So overall, from 2.5% interest rate to a 3% interest rate on $1 million loan, we're seeing a $265 increase in repayments per month. Yeah. Throwing back to your comments before, if you're borrowing $1 million, you should, be able to afford an extra $265 a month in repayments.
Yeah, exactly right.
In saying that, it's a big number. That's just over $3,000 increase per annum in terms of your repayments. But if you've got $1 million worth of debt, you'd assume that you've got the income to support it. So you should have a big enough surplus to be able to absorb and support that.
And if you don't, you should be speaking to a financial advisor, or you should be speaking to a professional to be able to help, capture that surplus and make sure that you do have that buffer in place, and B, ascertain, are you in the right property? Are you in the right mortgage for your circumstances? Because if you're that close to the line, if you're that far away from, whether you make mortgage repayments or don't, you should really be, looking into whether that is the right mortgage for you and whether it's an affordable mortgage as well.
Pretty straightforward. Should not be that close to the line, all else being equal. I mean, if there's other changes within the household, income suffers, job loss, bits and pieces like that, that's a completely different scenario. But agree 120% that, you should not be that close to the line, especially when we're talking at an interest rate percentage at such a low amount that we are today. It just shouldn't be like that.
And Billy, a bit of a plug into our mortgage broking department as well. Now's a really good time to be reviewing your home loan, reviewing your interest rate, making sure it's competitive. Whenever there's a movement, some banks will pass on the full increase in the RBA rate decision. Some will pass on a partial increase. Some will go above and beyond the RBA decision. And so now's a good time when you're sort of seeing those movements, either on the uptick or on the downtick as well. It's a good time to really be reviewing your interest rate, reviewing your lender, making sure that it's cost competitive, because, if you can reduce your repayments, increase your surplus, and utilize that money to either pay down the loan or invest or do any of the other million things that you can do with money, I'd much rather see it in clients' pockets as opposed to in the banks.
Yeah. And, in saying that, I don't know if you saw yesterday, but I think it was CBA and ANZ literally the same day came out and said that they're passing on the...
I think Westpac's done it as well.
And Westpac and NAB did the same thing today. Yeah. So all of the big four have already come out and said we're passing on the full interest rate increase. So it didn't take them long, not unexpected. That's the way they operate their business and stuff. But you're right. It's always a good time to review this whenever there's changes. And we've seen it as early as yesterday afternoon, heading into yesterday evening and this morning. The amount of phone calls that we're fielding around this is there's definitely an increase in activity because people are paying more attention to it. Even though, coming back to sort of the numbers that we threw up before, the numbers aren't that great and they're not or shouldn't be that significant in terms of a household budget. But we're already seeing that level of activity increase. So yeah, completely agree with your thoughts. Always good to review it, because if you can pay less, it's obviously better off in your pocket than paying interest to the bank.
Yeah, absolutely. So look, I hope that sort of summarizes a little bit about what's happening, the impact that that's going to have to the broader market, as well as, the impact that's going to have to your cash flow, your mortgage repayments, and, your own personal situation as well. Billy, thank you again for jumping on to another podcast with me. It's always good to reach out and speak to our listeners about some topical things that are happening, live and in the market, away from the day-to-day financial planning stuff. So thanks again for listening, and look forward to catching you all on the next one.
Beautiful. Thanks, Andrew. And to our listeners, as always, details in the show notes if you wanted to reach out for any further information. But thank you for your time and listening to our podcast. Thanks for listening today. If you have any questions on what we talked about or would like to have a chat about your money journey, visit us at 360fs.com.au.
Just a reminder to our listeners that the information contained in this podcast is general in nature and it is not intended as personal recommendations for the audience. Please consider whether the information suits your circumstances before acting on it. This information is provided by Billy Amaritis and Andrew Nicolaou of 360 Financial Strategists Proprietary Limited, authorised representatives and credit representatives of AMP Financial Planning.